1990s, Enron was widely considered one of the most admired and powerful companies in the United States. Investors were captivated, business magazines praised its innovation, and Wall Street analysts often called it a revolutionary force in the energy sector. At its peak, Enron's stock price exceeded $90 per share, giving the company a market value of more than $70 billion. Yet behind the polished public image was a network of hidden debt, complex financial structures, and accounting tricks that would ultimately lead to one of the most infamous corporate collapses in U.S. history. Enron was created in 1985 through the merger of Houston Natural Gas and Internorth. Initially, it operated as a traditional energy company, transporting natural gas through pipelines. By the 1990s, under Chairman Kenneth Lay and CEO Jeffrey Skilling, the company transformed into an energy trading giant. Enron didn't just deliver energy anymore. It created a marketplace where businesses could buy and sell electricity and natural gas contracts, locking in prices years in advance. Acting as a middleman, Enron collected massive fees while reporting enormous revenues. By 2000, it claimed over $100 billion in annual revenue, positioning itself as one of America's largest and most innovative corporations. To maintain the appearance of constant growth, Enron relied heavily on mark-to-market accounting. This allowed the company to record projected profits from long-term contracts immediately, even if the actual cash wouldn't arrive for years. For instance, a contract expected to generate millions over 20 years could be reported as immediate revenue. While this method was technically legal, it depended heavily on optimistic assumptions rather than actual performance. As some ventures began losing money, Enron's leadership hid the losses using special purpose entities, SPEs. These were separate partnerships designed to hold Enron's debt off the official balance sheet. Many were secretly managed by CFO Andrew Fastow, creating conflicts of interest and allowing billions in liabilities to stay hidden. For a time, this structure worked. Analysts praised Enron's innovative strategies, and the stock price continued to rise. But by 2001, doubts about the company's opaque accounting practices began surfacing. In August, Skilling unexpectedly resigned, raising concerns among investors. Shortly after, Enron announced it would take a $1 billion reduction in shareholder equity due to its partnership deals. Panic spread, and the stock began to plummet. As confidence evaporated, the hidden debts started to surface, and the fragile financial system collapsed. By December 2nd, 2001, Enron filed for bankruptcy, which at the time was the largest corporate bankruptcy in U.S. history. Thousands of employees lost their jobs and retirement savings, while executives who had promoted the company's strength had secretly sold large amounts of stock. Investigations revealed widespread fraud and conflicts of interest, particularly involving the auditing firm Arthur Andersen. Several executives, including Fastow and Skilling, were later convicted. The fallout led to major reforms in corporate accountability, most notably the Sarbanes-Oxley Act, which strengthened rules for financial reporting and executive responsibility. What was once celebrated as a model of corporate innovation became a stark warning of greed, deception, and the fragility of even the largest companies.